Hello and welcome to this edition of the Investortours University Commercial Real Estate Video Newsletter. In this newsletter, you're going to learn how to time real estate market cycles, specifically commercial real estate market cycles that are predictable, observable, and if you don't know how to time the market, not only can you miss out on a lot of your profit potential, but you can potentially buy at the wrong time and lose your money, your investors' money, and so much more. So market cycle timing is so very important. I'm going to teach you how to do that in this newsletter. My name is Dyke Drummond. I'm the Chief Learning Officer here at Investortours University at our home in beautiful Austin, Texas. And I'm also going to show you this now because I think it's particularly important as we enter this fourth quarter of 2010. I put links down below this video frame on the page showing 4 or 5 different articles that are speaking to the stabilization of the national economy and specifically to the stabilization of lending and the apartment industry. So now's the time to be thinking about jumping back in again. And let me show you in just a bit the specifics of how you time the market cycle to get in at the bottom. Now, you may have heard from your stockbroker friends or learned as a stockbroker that you should never try and time the market. Well, in commercial real estate, that's absolutely false. Commercial real estate deals in non-liquid assets. You can't jump in and out of an apartment building in a 10-minute push-button trade. And the net operating income and occupancy cycles of commercial real estate are predictable and typically quite long-term. So I'm going to show you here commercial market cycle theory and where you jump in. But before we start, there's a really, really important thing for all of us to remember. And that's this. There is absolutely no such thing as a national market cycle in commercial real estate, in sectors of commercial real estate like apartments or retail or industrial. When I talk about market cycles, I'm talking about a specific local market right down to the neighborhood level and a specific asset type. So when I talk about market cycles, I may be talking about if your target is Memphis, Tennessee, and you're in a 10 square block area of the downtown where you know there's a bunch of apartment buildings, I'm talking about the cycle for that market. Apartments in that 10 block radius, industrial property in this zip code. Because markets change neighborhood to neighborhood. Certainly different asset types can be in completely different places in the market cycle in the very same neighborhood. So remember, as we teach in our commercial quick start program, niche, niche, niche. What is your niche in commercial real estate? When you've defined your niche, that type of property and that business plan that gets you up out of bed, puts some spring in your step, gets you excited, you can become an expert more quickly, identify markets easily, and build your team of niche-focused experts quickly too. So as we talk about market cycles here, think about your niche and think about specific markets right down to the neighborhood level. There's another thing that helps you get market information quickly as well. And this is another concept that we teach in our commercial quick start system, and that's having a team. So if you said, okay, I want apartment complexes of 100 units or up in the north end of Dallas, Texas. I want them to be C-class, built in the 70s, and I'm willing to do some rehab to get them up to snuff and drive up their income. That's a niche. Now it's time to dive into that market and build your team. And because I'm talking about specific asset type market cycles and specific markets, you're going to be able to get intelligence from your team that you can't get anywhere else. Your property manager will know what properties in this niche are doing in this neighborhood. So make sure you have your niche and your team in place because that'll help you get the highest quality market information. There's a lot of other sources too that everybody has access to. Brokers' in-house reports, national reports you can get on LoopNet and get some of their paid reports in CoStar. A lot of this information is available, but the bottom line is you want to know in your niche, in that neighborhood, what are rents doing, what's occupancy doing, right? What are concessions doing? And we'll talk about that in more detail in just a second. Right now I'm going to take you onto my computer to show you a market cycle theory graph and show you what market timing looks like. Here we go. So here we are on my desktop. I'm going to show you some baseline market cycle theory, especially if you aren't familiar with this, and then we're going to talk about how you time the market. And again, when we're talking about market cycle theory, this is very specific for a single asset type in a single neighborhood or zip code or town. And I'm going to show you how to time the market because it's a predictable long-term cycle, and if you don't time it, you can actually have disastrous consequences. When you do it right, it actually helps everything get more profitable because you go up with that rising tide. So here we go, market cycle theory. We're going to show you a graph showing the interplay of several different factors: supply and demand within your asset type and occupancy all over time. So let's show you that on the next page. So here's a typical market cycle graph. You can see that it's a squiggly line that starts in the bottom and comes up to a peak and then goes back down again. And if we look at the y-axis over here, the y-axis is occupancy. So this is the occupancy of your asset type. And let's just be really specific. Let's say that this is apartment complexes in Raleigh, North Carolina. So here we have the curve of apartment complexes in Raleigh, North Carolina over time. And on the y-axis, on the x-axis is time. So if you watch this, it starts in the bottom left corner, comes up to a peak, goes back down again, and imagine it coming back over here and starting again. It's a constant up and down over the course of the market cycles, which are predictable and always based on supply and demand. This line across the middle that defines the middle of the graph is the long-term occupancy average for this asset type in this market. And the one down the center is one of the periods where supply and demand are in equilibrium. This one happens to be at the apex of the market cycle when occupancy is at its peak. If you're observant here, you'll notice there's a couple more places where supply and demand are in equilibrium, and those are both at the bottom of the market in this chart. Interestingly, that's what we're looking for. We're looking for the turn at the bottom. That's how we're going to time this market. So let's name these four phases. If we put the red lines in that make the X in the center, we actually have four phases to the market cycle. Bottom right is recession. That's as occupancy tanks because of oversupply and falling demand. Recession ends when it starts to turn back up again into the appropriately named recovery. Up here, this is called expansion, and on this side is called hypersupply. So recovery leads to expansion, leads to hypersupply, leads to recession. And right now in many markets around the country, we are in hypersupply or recessionary markets. And the articles that I've listed on the page below this video frame are showing us some signs of stabilization at the bottom. So let's talk about timing the market. As you can imagine, if you buy at the bottom, and oftentimes these market cycles will take several years to complete, if and when you buy as the market turns here, the rising demand, rising occupancy, rising rents, falling concessions will lift your property even if you don't do anything to it. A rising tide lifts all boats. The key is to buy in this area right here. Here's your buy signal, so that you ride that tide upwards. And what's really interesting is it's easy to see these buy signals, because if we look at what's happening just before the market turns, we're seeing falling occupancy. You'll also see falling rent rates, and you'll also see increasing concessions as the landlords in your niche, and again we're talking about in this case apartments in Raleigh, North Carolina, just as an example, the landlords in your niche have to give away more and more in terms of concessions to fill their apartment complexes. And the bottom is when you see occupancy stabilize, rent rates stabilize, and concessions begin to get burned off as the market turns. So what you're looking for is a cessation of these falling occupancy rates, a cessation of the falling rents, and a stabilization at the bottom. Now, the thing that drives demand in all commercial real estate is jobs. So if you've been watching a falling market for a while, it starts to stabilize at the bottom, and you can see long term that there is some good job growth prospects. It's time to put your lead generators out and see what deals are out there. That may be a buy signal for you. Let's talk real quickly while we're here about sell signal too. Sell signal comes here. And you want to sell when you get into expansion and are short of the peak. And the reason that I say that is if you wait till the very peak, it takes 90 to 120 days to sell a piece of commercial property. You want to have it under contract and almost all the way through the sell process before there's any danger of hitting the peak. So sell in mid-expansion, buy in early recovery. The danger is if you don't sell early enough, you're going to take the ride all the way down to the bottom. And any market that is falling occupancy, falling rent rates is on your watch list because it's clearly in recession and you don't want to buy there. But again, it's these stabilization signals that we're looking for. So stability in rents and occupancy after a period of falling is a potential buy signal. Get your lead generators out there. So there you have it, a crash course in market cycle theory and how to time the markets you can buy at the beginning of the recovery phase. So when you know your niche clearly, your local team is in action because you've identified some target markets and you see signs of stabilization with good long-term job growth prospects, that may be the turn of the market. Throw your lead generators in gear and start looking at deals. As long as that recovery upturn materializes, you may be buying nicely at the bottom and can ride that rising tide all the way to the top. So that's it for this month's newsletter. Dyke Drummond, Chief Learning Officer here at Investortours University at our home in beautiful Austin, Texas. You can always find us on the web at investortours.com, and here's to your success.